Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Thursday, November 14th, and I got my time covered up here. What time is it? It is 5:06 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Market state, we're in an uptrend. A lot of red on the screen today. We'll talk about that in a minute, but first, let's check the trend gauge over here. So we monitor the health of the market across three time frames on the major indexes, and all the major indexes are trending above their short-term 21-day moving average, medium-term 50-day moving average, and long-term 200-day moving average. Market leaders acting well also. So four green arrows, the coveted four green arrows, as I like to say, indicating we are in growth mode. But a note on growth mode, when you get a little too extended to the upside, you need to back off the gas a little bit, and the market won't go straight up, can't go straight up. It's not healthy. If it does, it will eventually lead to a very sharp decline if you get too extended above the moving averages. We didn't get to those levels, and we've been having a somewhat gentle pullback over the past 3 days. Today, that got just a bit harsher. It was a weekday already, but then at 3 o'clock, Jerome Powell came out with what were considered some hawkish comments. He said, "We're not in any hurry to cut rates." Now, the percentage of the likelihood of a Fed rate cut in the December meeting was about 80%. It dropped to around 60% after that. And stocks went to lows of the day and closed a little bit off the lows of the day, but still didn't help anything. And we're near the bottom of or at the bottom of the support range that we've been talking about over the last couple of videos. We'll talk about that when we get to the charts. But here are the final numbers on the day. Our 21 over 21 leaders list, not a good day, with only four up, one neutral, and 16 down an average of 1.21%. The big eight got got a spread description here for this. If you take out Tesla, which was down 5.8% today, as Trump announced his plan to end the $7,500 EV subsidiary, Musk already on record as saying that it didn't really bother him at all. It was really the more expensive vehicles by the other non-Tesla manufacturers that needed that to make their cars more affordable. But at any rate, it hit Tesla. The big eight, excluding Tesla, down 0.09%. So not a bad showing there, with Tesla down 0.8%. The RG8, all eight of them down. What is the RG8? It is our eight growth ETF composite. And I'll go through the charts of them tonight. It was something we created in 2021, the first quarter of 2021, to help us stay better engaged in exactly what's going on across the growth component of some major indexes. And there's ETFs that there are 8 ETFs that we use to track that. S&P 500 opened up by 0.1%, put in the high within the first 5 minutes. Never a good sign. You always want to monitor where you open and where you're trending during the day. And as I said, it was kind of a weak trend as the day was going along, but then accelerated to the downside after Powell, but down 0.6 on the S&P, equal weight S&P down 0.8. NASDAQ 100 opened slightly positive, also put in the high quickly, ended up down 0.7 on the day, equal weight just a bit worse than that. The Dow down 0.5%, mid caps down 1%, Russell 2000 opened up 0.4. And then rates started getting a bit worse, and the dollar started going higher. And sold off during the day, down 1.4%. Global diversified 60/40 stock and bond. This is 60% ACWI, 40% BNDW, down 0.25% on the day. Our flagship GROTECTION portfolio down 0.8. We'll get into the tail of the tape and some charts. But first, before I forget to do this, Thursday is the day that updates to two of the main indicators that we use for sentiment come out: AAII and NAAIM. NAAIM is a percentage of how invested are investment managers. And you can see across this 100 level here, if you poke your head above it, which we did not quite get to on today's reading, it's a little over 90. But every time you poke your head over 100, you can draw a straight line down, and it indicates that either a top or near a top in the S&P 500. So it happened back here late 2023. In December, not so much. We chopped around a little bit. Wasn't really as impactful. Uh, March and April here, near a top, we had a sell off from about 52.50 to 5,000. And then the most recent top in July, we sold off from there. So this is definitely something that, as a team, we keep an eye on when it comes out every Thursday. It's a pretty reliable indicator. Again, nothing to really be concerned about unless you get above that 100 level. Anything else is just noise. So let's get to the charts. Here's the S&P 500. You got your gap up after the election, two more days higher. That was last Wednesday, last Thursday, last Friday. Monday poked our head a little bit higher, but it was really a tight range consolidation day. Then we started pulling back, even though we closed higher yesterday. It was again a consolidation day, but the biggest down candle since we started making highs around the 6,000 level. So very clearly, 6,000 to 6017 is a resistance level that we've been unable to get above. Let's look at a 60-minute chart here. Actually, I think it's better on the 30-minute. And here's that 5950 that we've been looking at as support. There's a little bit of a gap fill here between last Wednesday and last Thursday. So arguably, if we look at the tops and the bottoms here, it's 59.36 would fill the gap and 59.47. So really, you could say 59.36 to 59.50 is a level that where bulls need to show up. Where do we close today? 1 point below that 59.50 level. Uh, Immediately, you want to see if we pull back a little bit more to fill this gap, which is very likely. In fact, I think we did fill it after hours, if I'm not mistaken. But Bulls, it's time for the Bulls to show up now after giving back and consolidating for arguably 5 days. Don't want to see much more given back. We've also noticed that of the last six pilot buys we've made in GROTECTION, only one of them is positive. And we also write down where's the S&P when we do those buys. And in all six cases, it's below the level that we bought at. This hasn't done any damage to the portfolio. In total, it's less than 0.5% because they're pilot positions and because we don't let our stops get out of control. But several of them are on the edge of getting stopped out. We'll talk about that in today's video as well. But here's the S&P 500 down at that 59.50 level. A little bit lower will fill the gap during the regular session tomorrow. And then, of course, you've got the gap up from the election. Um, there are several sectors that have weakened over the last couple of days as some of Trump's cabinet appointments have become clear, and some of them not so good for certain sectors, primarily ITA ETF, which is aerospace and defense, with the pledge to stop the wars, and also with the announcement today of Robert Kennedy Jr. being nominated for a high level HHS. That's hitting biotech and some of the pharma names. So uh, something to be aware of. So there's the S&P 500. Moving on, NASDAQ 100, same situation, fourth day pullback sitting right on the 8-day moving average, could fill the gap. Let's go to that same 30-minute chart. 510 was the level that we were watching. We poked our head below it several times today. And then the 1 o'clock weakness with Powell, we closed below it. A little bit further down would fill that gap. And levels to keep an eye on. Take it one level at a time, one stock at a time. Leave your stock, watch your stops, don't lower them. And commit to following the trend. The trend is up across all time frames except for the ultra short time frame where we've been pulling back and not really any damage being done. We're just pointing out various support levels that should hold. And if it gets a little worse than those support levels, for example, the 21-day moving average now up to this 500 level, which is where we gapped above, and it was the low of that gap day after the election. So that if we break down, that's just another 1.5% or so down to that level. That is would have a high expectation of bouncing, and if we don't bounce at that level, we would certainly be concerned. And I know that the market would be taking us out of some of our positions. And that's just the feedback that you look for. The market will tell you whether you're right or wrong. It's when you end up arguing with the market that problems start. So here's the Dow, very obviously peaked 3 sessions ago, breaking back below the 44,000 level, but still above the 8-day moving average. Now the S&P 400 mid cap breaking below the 8-day moving average and is now into the body of the long move up bar the day after the election. That 3,200 level is where the 21-day moving average is, and that's where we would want to look for support there, just a little bit more than 1% above that. And then finally, the Russell 2000 small caps, actually not finally, I'm going to show RSP. The 21-day moving average is right around that 2,300 level, which was the bottom of the gap up day on the Russell index with a break below after 3 harsh selling days lower, break below the 8-day moving average. Equal weight S&P 500 closed below the 8-day moving average and is into that candle. So there really was never a gap on that. If you look at the 30-minute chart, um, something not quite looking right about this. Sometimes with these ETFs, the timing of when individual names open doesn't follow through to the actual print on the index. Like, for example, that's what we would have expected it to look like with SPY. So it seems like that gapped up a little further than it should, or maybe it was a bad tick at the open. But anyway, daily chart of RSP. It's valid that it's below the 8-day moving average and has, let's see if the low of today filled the gap. The low is 182.12, so it filled the gap prior to the election going back 3 weeks. All right, those are the major 6 indexes. Let's go to interasset correlation right now, and we'll start with the VIX. The VIX was lower most of the day. It spiked late in the day. It's got a 14 handle, which we're very happy with. We want to see it below 16, which indicates a 1% range in the S&P 500. S&P 500 does its best work when the range is below 1%. We're working on a dashboard to be able to quantify that exactly, confirming some preliminary stats that we have. Here's the dollar. We had been asking the question, did the dollar peak with the election? The answer is an emphatic no. In fact, it made higher highs yesterday and today, and that's not good for stocks, and it's certainly not good for precious metals. GLD has been taken to the woodshed since the election, down another 0.25% today, below its 21 and 50-day moving averages. GDX bounced at the 200-day moving average today, finishing positive. So down from 44 to 35, quite a reduction there. Let's go to silver. SLV below the 21 and the 50, but positive on the day. And Bitcoin, big winner since the election, second day down today. And this is an evening star topping pattern. So Bitcoin needs to find some support around this area, down 2.6% today. Bonds, broad bond index, just barely down today, riding the 8-day exponential moving average lower. So this is bond prices. If bond prices are going lower, yields are going higher. And TLT up on the day, but closed at the bottom of the range. So up on the day, meaning that the yield's going down for the long bond, and it did. You can see here, so 2 tops. It's really still in kind of a big consolidation pattern, as we haven't convincingly from rates gone above this pre-election level. So there we are above, then a couple days below, popping above it, now below it. So this is trying to figure out the long bond, trying to figure out what it wants to do. Let's look at the 10-year. 10-year, same situation, had the gap up, then 2 days down, now 2 days up, and a reversal. All right, so that's our inter-asset correlation. Let's go to the tail of the tape. A couple of changes here. Deterioration in the stochastics of the indexes, three of them still neutral. They're all near or at overbought. Two of them had a crossover today to the downside. All the RG8 made it to overbought. Where did that just go? I believe that that is Microsoft Windows crashing right before our eyes, folks. Let me find this file very quickly. I know right where it is. And can't have a day without the tail of the tape, can we? Let's go to, I'm going to come back to that while that recovers, and we're going to go to some charts. So let's go to the 21 over 21. A couple things I want to talk about in here, specifically follow-up action to some names that we got stopped out of yesterday. Let's talk about why we got stopped out of them and what the charts did afterwards. So Kava knocked it out of the park on its earnings. It had a massive gap higher. Look at a 5-minute chart here, and sellers came in and it was being sold all day. And it was sold all day today as well. Now, normally when you have a big winner, you try to give it to the 50-day moving average. That's an IBD rule, but these rules are full of, excuse me, rules are full of nuances. And one of the nuances is does something make a blow off top? And if you draw lines across the tops on a weekly chart, it's got to be on a weekly chart, you can see that Kava opened above the top of this uptrend line, and that can signal an exhaustion gap, and that's exactly what we're looking at. So when it started to come down yesterday, we were down to a small position. The initial reaction on a big gap up like that is, well, do we want to buy it? Is it going to go higher? You don't like to see gaps higher after a substantial move has been already made, because obviously the easy money has already been made. But the gap up was very obviously sold, and we stopped out of our last piece of the position for a very nice gain. Another one that we got stopped out of yesterday was CART. And this is one where the reaction to earnings was not good, and it just no buyers whatsoever. Uh, Gap down and then continuous selling, went sideways, and really it's kind of found support around this 50-day moving average. Um, when it broke below the 21, we started selling a little bit, and we're out of it all by the end of the day. And it was because of the massive volume that it was being sold off on, and really any bounces were getting sold. So today, another an O'Neill rule, and something I mentioned about Kava, is that you should find support at the 50-day moving average if you are going to have a chance to continue your move higher. Found support yesterday at the 50-day, undercut just to get rid of those last. Let's look at this gap down. Let's get rid of anybody that's left holding this. That's what the algos were doing here. And then back above the 50-day moving average. We're not looking to get back into this. No real need to with the other positions that we have. We do have some cash available, but we're waiting for this pullback to stop. And there are certainly more attractive names than this, because that reaction just screams distribution. So we won't be looking for that for now. All right, tail of the tape. MS Word has recovered. Let's get back to it, because there's some important points in here that I want to discuss. So what I was saying was the stochastics, the RG8, all 8 of them were near overbought, at or near overbought, and have rolled over. So these are secondary indicators, but there's a bunch of secondary indicators on this page, and very often they all add up, and it ends up factoring through into price. NASI RSI hooked up. It is now neutral. The dollar's continuing higher. That's a negative. That's why that's in red. And the at best, the interest rates are going sideways, arguably higher. Uh, Sentiment, we always talk about this. The VIX, we want to see it below 16. It has a 14 handle. Fear and greed. We only get concerned about this if we go to extreme greed or extreme fear. Otherwise, that's always in yellow for neutral. Here's the NAAIM that I mentioned and showed before. It's at a 92. AAII, the bulls ticked up by 8. But there's a very nice paper out there that I read saying you don't need to be concerned about the AAII. Don't look at just what the bulls are doing. You also look at what the bears are doing. And when the bull percent minus the bear percent is 32 or more, that is when it's cause for concern. And we're not there. Obviously, 49 minus 28 is only 21. So we need a gap of 11 more points before this would give you like what would be considered a possible top signal as a secondary indicator. All right, moving on. The news we talked about with Powell, I did not mention PPI was hotter than expected. CPI came in line yesterday. PPI hotter than expected by 0.1%, both on the annual and the month over month. So that hit the futures a little bit before we even opened. So the keys coming into today, the two support levels we've been talking about, the S&P 500, 59.50 to the downside. We closed at 49.50 or 59.49, so we're right there. NASDAQ 100, 510, we closed below there. Obviously, like I said, the bulls, you want to see us get right back above that. Day count, 4-day consolidation, still above the 8-day moving average and the 21-day moving average on the S&P 500. So we have that wind at our back, and our expectations remain positive as long as we stay above the 21-day moving average on the S&P 500 and the NASDAQ 100. As far as sectors went today, also note that the S&P 500 ATR below a 1, which is where we want to see it, and going sideways. On the shorter term, it's actually dropping. On the 50-day, it's basically going sideways. We average those two together. Sectors. And actually, Market Surge did an upgrade, and they've got multiple moving averages to pick from ATR. They used to just give a 30-day percent, or maybe it was a 50-day percent, and you had to extrapolate it by exporting and doing some math. But they actually added 3 ATR percentages in there, 3 different time frames. So kudos to Market Surge for that update. So sectors, TLT, we already mentioned that up, and the dollar. XLE, the only one of the 11 spider sectors that was higher. ITB builders also higher because KBH, very nice. No, I'm sorry, it was Beazer, very nice reaction to earnings that drove that sector, which had been in the dumps. Had a nice day today, but BZH sold off from its gap up. 30-year yield down, 10 out of 11 of the spider sectors down. That's not good. Led to the downside by aerospace and defense, biotech, and healthcare. No changes to the portfolio today. We're waiting for the bulls to show back up before we add more exposure. And the bottom line on the day, stocks fade on Hawkish Powell, and it's now time for the bulls to step up as we're down near the bottom of this support range. Friday keys, we're going to see where we react around these support levels that we had the first close below today. So that's what we'll be keying off of tomorrow. All right, that's the tail of the tape. Let's get to some charts now. And in addition to CART, let's go through what we own. Actually, I said I want to go through the RG8, so let's do that first. 8 growth ETFs. And I'm going to turn stochastics on for this so you can see what I'm talking about, why all 8 have now rolled over. So they get to the top. Basically, this means upside momentum has paused and is now going lower. This is a 14-period look back on the stochastic. And it's crossing over the moving average, broke below the 8-day moving average. Obviously, no relative strength this week for growth leaders. IWO, this is the growth half of the Russell 2000 small caps. SLYG is the next one, same setup, broke below the 8. This is the growth half of the S&P small cap 600. The next one, MDYG, is the growth half of the S&P Mid Cap 400. Same situation, same setup on all of these, breaking below the 8-day moving average. And they went from a wind at our back to a wind at our face. And again, that's just another key that we use to slow down on the buying. That and the feedback, as I mentioned, that we've been getting from our last few buys. QQQJ is basically a mid cap NASDAQ 100, same situation. These are all, they were all in sync on the way up. They're in sync on the way down over the last couple of days, hooking over from overbought and close to or at crossing the moving average on the stochastic. PDP is a Dorsey Wright momentum indicator, still above the 8-day. SHYB is the S&P 500 high beta. Same thing, hook over, sitting on the 21-day moving average. FFTY, this is the IBD 50. We really like that it broke out of this nice cup base, but as of right now, it's a failed breakout back into the base, and this is in sync with what we've been seeing from the growth names that we monitor and own in our portfolio. So FFTY rolling over, and then finally ARK-K, really making some nice moves up because of Coin and Tesla. Tesla pulling back the last couple of days. This is sitting right on the 8-day moving average. The breakout still intact from after the election. So that's the RG8. Let's go to the 21 over 21 list now and look at some key players in here. So everything that we own in the portfolio. Here's NVIDIA. I'm gonna go back and turn stochastics off so you can see the chart a little bit better. There's NVIDIA going flat basically for the last 6 sessions. Vertiv pulling back right below the 8-day moving average. A-Lab right below the 8-day moving average. And again, no technical damage done to these. Some of them at worst are just barely below their 8-day exponential moving averages. MicroStrategy has had a huge run. Big negative reversal yesterday. We took some off. Basically closed unchanged yesterday, still above the 8-day moving average. Here's Bitcoin. Negative reversal yesterday, forming an evening star pattern, as I mentioned. Reddit continues to, this is what you want them all to do. Indices pulling back, this one staying tight right along the highs, riding that 8-day exponential moving average higher. Dell going sideways for the last 6 days, not showing any relative strength. Dutch Brothers consolidating inside the big candle from its earnings gap. Note the difference in the behavior from this against what we saw with Kava. The difference, of course, is that this didn't have the huge uptrend, didn't even have the numbers that Kava had, but this is certainly a bullish reaction so far. It's very normal after an earnings gap up to pull back and find support above the low of the gap day and the 8-day moving average before propelling higher. And if that doesn't happen, that tells you all you need to know about the stock's prospects. Tesla pulling back now, harshest pullback, down 5.8% with that announcement of the subsidies. Coherent, we got into this yesterday. Our stop is just below the 21-day moving average, and it's sitting right on the 21-day moving average. And then the two that we sold yesterday, there's Kava and Cart, and that's going to wrap it. As always, like to hear from you. Let's fix this. And if you're reaching out, the email for me is don@revereasset.com. If you're interested in becoming a client, my partner Dan Stewart is at dan@revereasset.com. And the phone is 855 Real Wealth. That's 855-732-5932. Our flagship portfolio, GROTECTION. Dual mandate, just like the Fed. We like our dual mandate better. And that's growing assets in uptrends, protecting them in downtrends, lightening up when the short-term and medium-term trend start to fade. Maximum defensiveness below this black line. That's the 200-day moving average. This is where every bear market in history has occurred. If you're above that level, at least from an index perspective, the S&P 500, give the market the benefit of the doubt. If we get to near there, Very similar to what happened back here in July. Note what happened in July. I mentioned we got above 100 on the NAAIM. As these levels are broken on the indexes, we're going to be taken out of most of our individual names. We will hold an index position in here while the market decides if it's finished going down or if it's going to put on the brakes to the downside and reaccelerate back to the upside, in which case we will re-engage with the market using our indicators across those three time frames and the action of leading stocks. And with that, I'm going to wrap it for Thursday, November 14th. This is Don Vandenbord with Revere Asset Management telling it like it is. Thanks for listening and have a great day.